We've seen a lot of news lately about private credit funds getting redemption requests from their investors. Today, we're joined by Jeff Carter, a portfolio manager with Canso Investment Counsel, to help us understand what's been going on. So Jeff, can you tell me a little bit more about what's going on in this market?
Sure. So, the private credit market has grown significantly over the past decade. In fact, it's a market that's tripled over that period to roughly $2 trillion. It now exceeds the size of both the high-yield bond market and its close cousin, the term loan market. There are substantial differences between private credit and the high-yield and term loan markets in terms of their mechanics. While high-yield bonds and term loans are typically broadly syndicated to a swath of investors, private credit is typically not syndicated and ends up in the hands of one or maybe a small number of investors. In addition, the banks who syndicated the high-yield bonds or term loans will typically facilitate a secondary market for investors to trade in or out of the high-yield bonds or term loans. The secondary market trading gives investors the ability to mark-to-market those assets based on the latest trading price, giving investors an accurate valuation of the assets or funds holding those assets. However, banks typically will not facilitate secondary markets for private credit, which leads to uncertainty of the value of the various private credit assets. Now, most recently, we've seen a couple developments which have caused some investor concern in the private credit market. Firstly, we've seen some loans marked down in a dramatic fashion by private credit managers, sometimes taking a loan which was marked at 100 cents on the dollar down to a deep discount or even to zero over a pretty short period of time. The concern here is that without an active secondary market, it doesn't give private credit managers the opportunity to reduce their exposure should some liquidity be available. The second development that we've seen is a rise in the redemption requests from investors to private credit funds. Several private credit funds have seen redemption requests from 10 to as much as 40% of the funds. In some cases, investors have not had their requests fully met, as often the funds will cap their quarterly redemptions at perhaps 5% of the fund size. And so the concern here with significant redemptions is always, how is the redemption going to be met? And most importantly, what assets are left behind for investors who choose to remain in that fund? I'd say overall, we think markets will monitor these developments in the private credit market, and certainly we could see some of the money which migrated into private credit over the past few years migrate back to the high-yield bond and the term loan markets.
Thanks very much, Jeff. You can find out more about what's happening with private credit in the latest Canso Corporate Bond newsletter. Click the link in the caption if you'd like to access it.